what if I told you that the most statistically profitable crypto trade over a recent 6-year period wasn't buying the momentum winners,
Right.
and it wasn't, holding the safest blue chip tokens either. It was actually scooping up the absolute worst performing, most beaten down assets from the previous 3 weeks.
Which sounds completely backwards.
It really does. I mean, we have this ingrained perception of cryptocurrency as just a pure casino, right? Like a speculation engine completely untethered from any fundamental logic.
Oh, absolutely. Just driven by whatever meme is trending on social media.
Exactly. We just assume it's pure chaos. But the math is starting to suggest something entirely different. Welcome to today's deep dive, where we're going to get into that exact math.
That assumption of chaos is completely understandable when you just look at the surface level price action. Like you see a token drop 30% over a single weekend, and you just naturally conclude there's no underlying structure there.
Yeah, you just panic.
Right. But when you apply rigorous institutional modeling to that exact same price action, you find that the chaos is actually highly organized. There is a measurable mathematical science dictating those moves.
And that structural math is our focus for this deep dive. We're unpacking this fascinating May 2026 paper titled Crypto Has Fundamentals, a 7-factor model for digital asset returns by Farid Babayeva and Nijat Aliyev.
A really incredible piece of research.
It really is. So they built this analytical engine called the Quantness-7 or Q-7 model, and they basically took 90 different digital tokens and ran them through this model across a massive sample period.
Right, from January 2020 all the way through May 2026.
Yeah, with the specific mission of proving that crypto returns are driven by 7 specific quantifiable factors and not just random luck.
And to understand why this matters to you, like anyone managing digital assets or just watching their portfolio, you have to look at how traditional finance operates.
Oh, for sure.
If you look at an equity portfolio, Wall Street has relied on these analytical toolkits for decades. Things like the Fama-French models.
Right, the classic Fama-French stuff.
Exactly. And those models deconstruct a portfolio's returns to figure out if a manager actually has, true skill, actual alpha, or if they just got lucky by over-indexing on tech stocks during a massive bull run.
Yeah, distinguishing the geniuses from the lucky gamblers.
Oh, precisely. But the crypto sector has severely lacked that kind of empirical institutional risk decomposition. So when a token went up, the market just threw its hands up and attributed it to hype.
And the Q7 model is basically attempting to provide that missing Fama-French equivalent for digital assets.
This is exactly what it is.
So the researchers started by testing the traditional equity factors first. Obviously, they included a broad market factor because, the tide of Bitcoin and Ethereum largely lifts or sinks all ships.
Right. The whole market moves together a lot of the time.
Yeah, but where the data takes a sharp turn is when they isolated size and volatility. Okay, let's unpack this. Because historically, early crypto research suggested there was this tangible size premium.
Right.
Meaning, like, if you bought tokens with smaller market caps, you systematically outperformed the majors.
And what's fascinating here is that perceived size premium was just a widely accepted narrative in this space.
Oh, everyone believed it. Small caps equal big gains.
Exactly.
Yeah.
But the Q7 model exposes it as a complete statistical illusion.
Yeah.
The researchers recognize that in crypto, small tokens are almost universally more volatile.
Right.
So they applied a technique called orthogonalization. Essentially, they ran a regression to isolate the variance explained by size for the variance explained by volatility.
Like mathematically scrubbing the overlap between the two.
Yes, mathematically scrubbing the overlap. And
Yeah.
once you do that, once you put the volatility of a small token and a large token on equal footing, the actual reward for simply holding a small cap token just vanishes.
Wow.
Yeah, the t-statistic drops to a completely insignificant 1.36.
It's like assuming a dog is loud just because it's small, like a chihuahua.
I love that analogy.
Right, but when you look closer, it's not the actual size of the dog making the noise, it's the anxiety, the constant shaking.
Yes.
In this paper, researchers found the exact same thing with token size and volatility. The tokens weren't being rewarded for being small, they were being rewarded for being highly volatile.
That is a highly accurate way to frame it. And discovering that volatility is the true driver leads to this major structural divergence between crypto and traditional equities.
As the low volatility anomaly.
Exactly. In the stock market, we have low volatility anomaly.
Yeah.
Decades of data show that if you build a portfolio of boring, low volatility stocks, you actually generate better risk-adjusted returns over time than if you buy highly volatile stocks.
So traditional markets reward you for playing it safe?
They do. But the Babayeva and Aliev paper proves that crypto completely inverts that logic.
Yeah, it's totally backwards.
The Q-7 model found that high volatility tokens significantly outperform low volatility tokens. You are actively penalized for playing it safe in crypto.
That's wild, but I mean, why is that?
It comes down to market demographics. Traditional equities are dominated by institutional players. Pension funds, endowments, insurers.
And they want stability.
Right. They are structurally risk-averse. They prioritize capital preservation. But the crypto market, particularly during that 2020 to 2026 sample period, is heavily influenced by speculative retail capital and highly leveraged proprietary trading desks.
People looking for that lottery ticket.
Exactly. These participants are explicitly seeking asymmetric upside. They demand a much higher premium to take on that extreme idiosyncratic risk, which structurally forces high volatility assets to yield higher returns.
Okay, but if the bedrock of the market is just a massive premium for bearing volatility, that raises a pretty cynical question.
Which is,
Does the underlying technology actually matter? I mean, we talk endlessly about tokenomics and block space and network utility, but if the market just rewards the most volatile assets, maybe fundamental value is irrelevant.
and that tension is exactly why the Q7 model moves beyond basic price and volume metrics.
Right.
To test if utility anchors price, the researchers utilize the inherent advantage of blockchain technology, which is on-chain data.
Here's where it gets really interesting. Because unlike traditional stocks that report quarterly, crypto networks stream real-time operational data 24/7.
Exactly. So they constructed two fundamental factors, quality and value, based purely on that real-time operational data.
Let's focus on the quality factor first, because the performance metrics attached to it in the paper are just striking. Quality in this model is an aggregate of genuine network activity.
Right, it's not just hype.
Yeah, it evaluates active addresses, the total economic value transacted, throughput, and crucially, the fee revenue generated by the network. It's measuring whether people are actually willing to pay for the block space.
And the output for that quality factor is perhaps the most significant finding in the entire study. It proved to be the single most robust predictor of forward returns across the entire 90-token cross-section.
It's amazing.
It achieved a Nui West T-statistic of 9.80,
Which is huge.
phenomenally strong. It indicates a statistically significant relationship that tokens backed by networks with intense, verifiable usage systematically command higher returns.
But wait, I have to challenge the methodology there for a second, because if you measure active addresses and fee revenue, aren't we just building a proxy for Bitcoin, Ethereum, and Solana?
That's a fair question.
Right. I mean,
Yeah.
the largest networks by market cap naturally process the most economic value. How do we know this quality factor isn't just the size factor sneaking back in through the back door?
The researchers anticipated that exact critique, which is why the math here is so rigorous. They applied that same orthogonalization process to the quality factor.
Oh, the scrubbing technique again.
Exactly. They cross-sectionally regressed the quality metrics against market capitalization and the value metrics, basically isolating the residuals.
Meaning they mathematically stripped out the absolute advantage of simply being a massive network.
Correct. They forced a relative comparison. So if you take a mid-cap token and a large-cap token and adjust for their size, the network that exhibits higher proportional usage and fee generation consistently outperforms.
That's fascinating.
It proves that utility isn't just a byproduct of size. Genuine on-chain traction acts as a gravitational pull on the token's price over time.
And they applied a similar lens to the value factor too, right? Translating a traditional equity concept into blockchain mechanics.
It did.
Instead of comparing a stock price to book value or quarterly earnings, they compared a token's market capitalization to its rolling on-chain economic output.
It functions exactly like classic value investing.
Right.
If a network is facilitating a high volume of economic activity relative to a suppressed market capitalization, the Q7 model flags that token as fundamentally cheap.
Like finding an undervalued stock.
Yes. And the data confirms that acquiring fundamentally cheap block space strongly predicts higher subsequent returns.
So we have a clear mathematical case that utility and on-chain fundamentals drive value. But anyone who trades these assets knows that the day-to-day market does not feel fundamental at all.
Definitely not.
It feels purely psychological. It's driven by liquidations, momentum, extreme sentiment shifts. A purely fundamental model would miss the human element entirely.
Which is why the Q7 model incorporates behavioral finance as well.
Right.
The researchers built two specific factors to capture market psychology and positioning: short-term reversal, and funding sentiment.
The reversal factor is where this paper directly challenges the existing academic consensus.
It really is a major shift.
Yeah, there was this highly cited 2022 paper by Liu and colleagues that concluded crypto was a momentum-driven market. The prevailing wisdom was that winners keep winning, so you just buy the breakout.
Right, trend following.
But Babayeva and Aliyev, using a much broader data set that captures multiple bear and bull cycles through 2026, prove the exact opposite.
And if we connect this to the bigger picture, the divergence is stark. The Q-7 model demonstrates that on a 21-day horizon, past losers drastically outperform past winners.
Wow.
Yeah. If you systematically isolate and buy the tokens that suffered the steepest declines over the prior 3 weeks, you capture a massive premium. The strategy generated a 151% annualized return in their backtesting.
151%. And the mechanics of why that happens are fascinating because it really comes down to market microstructure.
Exactly.
In traditional finance, a drop in price might reflect a slow downgrade in a company's earning potential. But in crypto, steep drops are almost always exacerbated by liquidity crunches.
Right, the leverage just cascades.
Yeah, when a token starts sliding, it triggers algorithmic stop losses and forced liquidations and all the decentralized finance protocols.
And the selling becomes entirely detached from the network's fundamental quality at that point. It just becomes mechanical.
Pure math taking over.
Yeah, forced liquidations create a vacuum of liquidity, and the price heavily overshoots its fundamental floor. But once that mechanical selling pressure exhausts itself, once all those leveraged longs are just wiped out, the asset is wildly mispriced relative to its utility.
So it snaps back.
It rapidly mean reverts upward.
And the researchers prove this isn't just broad sector rotation either. Like, it's not simply buying the DeFi sector when it crashes. This reversal effect holds true within specific categories.
Right.
If you look purely at layer 1 blockchains, the individual token that suffered the most extreme downside deviation is statistically the most likely to snap back the hardest. It's a highly localized psychological overreaction.
And the second behavioral factor, funding sentiment, approaches market psychology from the opposite extreme.
Right. Instead of measuring panic, it measures greed.
Exactly. Measuring greed and crowding. The model analyzes the funding rates on perpetual futures contracts.
And to understand the signal there, we have to look at how that derivatives market is structured. Persistent high positive funding rates mean that traders taking long positions are continuously paying a premium to those taking short positions just to keep their trades open.
It's a huge drag on their portfolios.
Yeah.
And when you see funding rates remaining elevated over a sustained period, it tells you that the trade is fundamentally saturated. Everyone who wants to be long is already long, and they are so euphoric that they are willing to bleed capital every 8 hours to maintain that leverage.
The greed is just off the charts.
Right. And the Q-7 model interprets this as a strict contrarian indicator.
Because if everyone is already on one side of the boat, there are literally no marginal buyers left to push the price higher.
Precisely. And the slightest bit of negative news will send all those crowded longs rushing for the exact same narrow exit, triggering the exact liquidation cascades we just discussed.
Yeah.
By systematically shorting assets with excessively high funding sentiment, the model identified a highly profitable independent signal with a t-statistic of 6.74. It is mathematical proof that fading extreme greed works.
I can hear the gears turning for anyone listening to this right now. You lay out a model that buys high-quality networks, fades crowded leverage, and buys deeply discounted assets after liquidity cascades. And you mentioned 151% annualized returns.
It sounds too good to be true.
Right. The immediate instinct is to ask, okay, how do I program this into a trading algorithm today?
Naturally.
But these factors don't exist in a vacuum. So if I know these factors, do I just buy high-quality, heavily beaten-down tokens and become a millionaire? How do these factors react when the macro environment shifts from a brutal bear market to a euphoric bull run?
And that is the crucial reality check of the paper.
Right.
The researchers didn't just calculate average returns. They conducted a regime-dependent analysis. They integrated their factors with the alternative.me Crypto Fear and Greed Index to understand how these anomalies behave across different market environments. And they found that factor performance is highly conditional.
So the behavior of the reversal factor across different regimes is a perfect example of this. You mentioned it generated 151% annualized overall.
Right.
But when the researchers isolated periods of extreme market fear, the reversal strategy absolutely dominated, posting a massive 234% annualized return.
Which makes perfect structural sense based on the liquidation mechanics we discussed earlier.
Yeah, because of the panic.
Exactly. Deep fear implies panic selling, which produces the most severe price dislocations and the sharpest mean reversions. But the inverse is also true. During a greed regime, when the broader market is euphoric, the reversal factor essentially flatlines.
Because there's no panic selling to exploit.
There's nothing to snap back.
So if reversal loses its edge in a bull market, what steps up?
During greed regimes, the value factor takes over entirely. The data shows that buying fundamentally cheap tokens during euphoric periods generates an extraordinary 365% annualized return.
365%. I actually found that highly counterintuitive when I read it.
Really? How so?
Well, traditional logic suggests you hunt for value when the market is depressed, right? When assets are trading below book value and nobody wants them, why does value investing suddenly work best when the crypto market is acting completely irrational and greedy?
It's because of the way capital flows in a crypto bull market. Euphoric regimes are characterized by massive inflows of new capital looking for deployment.
Just a tidal wave of money.
Exactly. But as prices across the board inflate, larger investors and institutional capital start seeking justification for those high valuations.
Ah, they need a reason to buy.
Right. They actively hunt for networks that are actually generating the fee revenue and on-chain metrics to support the hype. They rotate their capital into fundamentally sound, relatively cheap projects to anchor their exposure.
That makes a lot of sense. That leaves us with reversal for bear markets and value for bull markets. Did any of the 7 factors perform consistently regardless of the fear and greed index?
Yes, the quality factor. Tokens with intense, verifiable network usage delivered steady, positive premiums across fear, greed, and neutral regimes. It is really the only true all-weather fundamental factor in the Q-7 model.
Okay, we need to hit the brakes and address the elephant in the room.
The limitation.
Yes, we are throwing around percentages like 234% and 365% annualized returns. It is absolutely vital to explain why these are academic backtests and not a license to quit your day job tomorrow.
Strongly agree.
The authors include some very stark warnings about the friction between theoretical modeling and real-world execution.
The limitations are substantial,
Yeah.
and to their credit, the authors are highly transparent about them. The primary issue is survivorship bias.
Right.
The Q-7 model analyzes 90 tokens that maintain sufficient liquidity and market capitalization through May 2026.
Which means the dataset systematically excludes the catastrophic failures.
Exactly. Tokens like ELNA or FTT, which suffered terminal collapses and wiped out billions in equity, are not represented in the sample.
They just go to zero and disappear from the data.
Right. If you were executing this strategy dynamically in 2022, your portfolio would likely have held some of those assets before they went to zero, which would drastically reduce the overall return profile.
And beyond survivorship bias, there's the simple friction of market mechanics. The reversal factor, for instance, requires rebalancing every 21 days.
Yeah, that's a lot of trading.
You're constantly selling winners and buying illiquid losers. In the real world, the bid-ask spread on mid-cap tokens can easily exceed 1 or 2% on a single trade.
The transaction costs of high turnover strategies and fragmented liquidity pools would severely erode those theoretical premiums. That is why it's critical to view the Q-7 model not as a proprietary trading algorithm, but as a risk decomposition tool.
Yeah.
The true triumph of the paper is its explanatory power. By applying these 7 factors, the researchers can explain 85% of the cross-sectional variance in digital asset returns.
They proved the casino has an underlying math.
They did. They demonstrated that the market isn't just reacting to social media sentiment. It is systematically pricing in volatility risk, on-chain utility, and behavioral extremes.
So what does this all mean? Synthesizing everything we've unpacked today, the takeaway is really a fundamental shift in perspective.
Definitely.
Yes, digital assets are incredibly volatile. But by looking under the hood at verifiable quality metrics, understanding the contrarian signal of funding sentiment, and recognizing how forced liquidations create reversal opportunities, you can view this asset class with the same analytical rigor used for traditional equities.
It is a maturing market.
It really is.
And that maturity introduces a very compelling, somewhat provocative thesis for the future of the space.
Oh, I like where this is going.
Well, the Q-7 model proves that crypto currently operates on its own unique rules, like the fact that high volatility is rewarded, which is the exact opposite of traditional stock markets.
Right.
But as this research disseminates, And as Wall Street's algorithmic funds begin deploying capital based on these exact fundamental and behavioral models, what happens to the market structure?
You're suggesting the very act of observing and trading the anomalies might neutralize them entirely?
It is a well-documented phenomenon in traditional finance. If enough massive, risk-averse institutional capital enters the space, utilizing rigorous factor models, their sheer volume could arbitrage the anomalies away.
Wow.
By measuring and trading the unique rules of the crypto market, Wall Street may ultimately tame it. In a matter of years, these wild, idiosyncratic returns could compress, and digital assets might just trade with the same correlated efficiency as the S&P 500.
The moment the institutions solve the math of the casino fundamentally changes the game. That is a brilliant concept to end on. Thank you for joining us for this deep dive into the Q-7 model. The next time you see a massive red or green candle on your portfolio tracker, hopefully you'll look past the noise and see the structural mechanics at play. The volatility isn't random. There is an engine under the hood. Catch you next time.